Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at that disclaimer. And let's welcome Demetri Pargmanic to the stage. How you doing, D?
Good morning, Will. How are you?
Great.
Let's share my screen here.
And today we're going to look at how to read options, trade in time and sales, analyzing the OPRA report.
Yeah, we're going to go over quickly how to take a look at the time and sales for options trades and just the significance of it and where these trades are coming from, so people understand the concept idea behind trade time and sales. I'm gonna go to a symbol for our example, and I think the last one I was looking at was TLT. So let's type in a symbol to TLT, which is iShares ETF, the 20-year Treasury bond ETF. On the left-hand side, we have a menu. Click on options and then click on time and sales. And you come to this page. I'm going to close this menu to expand our screen. And on this page, you will see a table with different items in there. And each of these items represents an actual option trade in TLT. So first, let's just discuss where these trades, they're reported. Because with options trading, we have many different option exchanges. We have CBOE, which is a Chicago exchange. We have the Philadelphia Stock Exchange. We have, the BATS exchange. We have all these different exchanges that trade options. I think there's like 16 or, a bunch of them. And they could all have trades on these exchanges, and these exchanges list the same symbols. So you could have trade, in TLT that traded on CBO or on the BATS and so forth. So all of these exchanges, have trades on them, and they report, once they have a trade, they report it to a central authority, which is the OPRA Feed. We call it the Option Pricing Reporting Authority. Okay, so all of them go and report it to the OPRA Feed, and then the OPRA Feed consolidates those trades, creates a feed. So you could subscribe to the OPRA Feed or subscribe to a vendor that through the OPRA Feed, and this way you could get all these trades that happen on exchanges. So let's go over some of the elements here on this time and sales, and then we'll discuss the importance of it. And the first column you see is the time of the transaction, right? So all these are ordered in time, and this allows you to analyze the trades based on the sequence of their reporting. And it also allows you to analyze the trades based on the timestamp of when it happened. This becomes very important for many reasons, but when you have timestamps associated with it and you're doing analysis, you could also analyze other events that are occurring around that same time. So if you're looking to analyze trades, maybe even before an event happened, like let's say the Fed announced interest rates at 2 p.m. Well, if you know that, then you can analyze trades 5 minutes before that, 10 minutes before that, 5 minutes after, 1 minute before. it becomes very important. You can analyze trades right before the close. You could analyze trades right at the open, or right um, um, around other correlating things, like, maybe some news came out during the day, where you could see if there's anything unusual happen right before that news came out, to analyze that. Or you want to see how certain things correlate. Well, by having timestamps, it becomes extremely important um, for trader analysis, for research and trader analysis. So that's why I call it time and sales. The timestamp and the trade, or the sales that occur. Then over here, we have the description of the option that traded. So when we talk about options trades, well, we have different expirations, we have call or put, we have different strikes. So it's important to understand, well, what was the contract that traded? Okay, so you can see here we have the expiration here, if it was a call or put, and the strike. So that identifies which contract traded, because unlike a stock, let's say IBM just has IBM stock, right? The options markets have different option contracts. It's important to identify them, and then later on you could aggregate them, you could compare them, and so forth. But it's important to identify, well, what was the contract. Then we have the quantity of the trade. And this becomes important also because you could have a trade that trades one contract, or it could trade 10 contracts or 1,000 contracts or even more. So the amount of the trade happens. Not every trade is the same, right? Some trades are just let's say a one lot, where then you could say, okay, maybe that was just like a retail trader or somebody small. But then you could have a really big trade where you're like, well, something else happened here where that looks like an institutional size trade, or something else going on. I don't see very large trades in this screen, but we see 10, 12, 6, ones. And again, that becomes an important part in your analysis. And the price it transacted. When you're analyzing, you want to know the price of the transaction. Those are important pieces of information, especially if you're analyzing the trade and where things traded and what prices people paid and what prices people sold. That is part of your time and sales. Okay, these are all critical data points in your time and sales. Here we add a little bit more, and this translates the trade price and the quantity into the total dollar value. So this is something we calculate, and it's not on the OPRA feed itself, but this shows you an example where you take the OPRA feed and you create more analytics from it. And this is a simple analytic, but this just tells you the dollar value of the trade. And it's easier then to kind of sort or arrange or filter by, because the dollar value of the trade, you could have one contract, you could see that was $20. Here's one contract that was $48, and here's a couple other ones that are nice. So not every trade is the same dollar value or notional. And this gives you an example of how you further take the raw data and start creating more derived analytics, to help with that research or spotting things or finding things. Now, with the time and sales in OPRA, they have two actual feeds. So the feeds are one where they report transactions. Those are the actual trades. Another feed, they report the bids and offers in the option. So the bids and offers are made up of streaming quotes like market makers and specialists, and then the limit order book where people put in limit orders, that could be resting. They could be orders that are also pegged, but the order book and the streaming quotes, they make up the bids and offers, and each exchange has its own bid and offer. So the CBOE has bids and offers, the NASDAQ has bids and offers, and it could be in the same option. And so for each exchange, they have the best bid and offer, right? The best bid and offer means the highest bid on that exchange and the lowest offer, lowest ask. So that's the best, because the highest bid is the best bid because that's the most somebody's willing to pay. A bid below that is inferior. The lowest ask is somebody willing to sell it at the lowest price, cheapest price. Anything above that is inferior. So each exchange has what they call the BBO, best bid and offer. Well, since we have multiple exchanges, right, the national best bid and offer is the best bid displayed aggregating all the exchanges. So if there are 16 exchanges, only one exchange is showing 19 cents bid and all the other ones are 18 cents, the 19 cents is the national best bid. If all of them are showing 19 cents, that's fine. Then they're all, that's the highest, and they're all displayed 19 cents. Same thing with the ask. It could be one exchange, two exchanges, all exchanges, but the national best bid and offer takes into consideration all the exchanges. It aggregates and says, well, what is the highest bid price? What is the lowest ask? And that makes the consolidated national best bid and offer. So we could compare those two feeds and say, okay, well, at the moment of the trade, because we have a timestamp, right? So we have a timestamp of the trade, and then we could go and find the timestamp of what was the national best bid and offer at that time. And now we consolidated two feeds so we can make a comparison. So you see how the just on this time and sales alone, the timestamps became important because now we're comparing two feeds that are related, relevant to each other, that we could put it all on one row, on one line to get this information, to get us, more insights of what happened. This doesn't come on one feed. You'd have to go in there and consolidate it. And the importance of it is to see, well, where did the trade or the transaction happen relative to where the best bid and offer was, national best bid and offer? Was it on the ask of the higher end of the national best bid and offer, which would be the ask price, on the lower end, which would be the bid price, or somewhere in between? And that kind of helps us then analyze the order flow in relationship to the displayed bids and offers. Okay, so over here, just to make it easier, if the trade price happened on an ask, we just put that here. If it happened on a bid, we put that here in the mid. So this is just an analysis of these two, right? The analysis of the trade feed versus the quote feed. And then we have that. So going now further, if we have the option trade price, right? And we have the timestamp, right? So we have a timestamp and the option trade price. Well, we could also then find what the stock price was at that time. Okay, so over here, this is the stock price, 84.56. And that's important too, because with an option's value, it's a derived value, right? It's derived because its value is based on where the stock price is. Let's think of a call. A call option, if the stock is higher, is worth more. If the stock is lower, it's worth less. So it's a derived value. And it's a derivative, right? An option is a derivative. So it's essential for your analysis to understand, well, when this option traded at this price, well, where was the stock, right? Because then you could then make that analysis. So here we look at the stock price, and this is a third feed because the stock price doesn't even get reported by the options exchanges, right? There's a stock, the stocks trade on stock exchanges, not on options exchanges. So then you got to get a feed from the stock exchange, and you got to get the consolidated feed and see where was the stock price at that moment. So then when we have the stock price and the option price and the timestamp, what we could do is create more analytics, right? We could plug that into the option pricing model and say the option pricing model could then tell us what was the implied volatility of that trade. Okay, so here's the implied volatility of that trade, 19.8. And that becomes important because when we think about options, yes, we have an option price, but the option price only tells us a little bit of the information because it's dependent on where the stock was at the time. So the implied volatility makes it a relative value. Then we could really analyze what was the premium that this transacted, the relative premium, and that we convert to the implied volatility. Okay, and this way we could compare the implied volatility levels for previous trades to trades that happen maybe on other options around it. And we could also look at the trends, if the implied volatility is increasing or decreasing or staying the same, or are the trades around that implied volatility, are the trades very close to the average, or how much do they diverge or disperse around it? So then we have those critical pieces of elements information to help us make those trading decisions. Another thing is we could look at the delta of the option, right? We can plug all that in and then create a delta, right? The delta will tell us those option Greeks. What was the option Greek of that option? Its sensitivity to a $1 move up or down. Okay. These are all derived values because we're plugging the raw data into our models to get those derived values. Open interest, now that gets reported by a different entity. That's the Options Clearing Corporation. The exchanges themselves don't clear options. They don't. They have transactions. They have quotes, but they don't clear the options. The Options Clearing Corporation clears options and guarantees them for all the exchanges. And they reconcile how much open interest there is. That's something they do, right? The Options Clearing Corporation is an entity, and they keep track of the open interest, the exercises, the assignments, the the options that are listed, delisted. So the options clearing corporation gives us the open interest. And that open interest is reported once a day. So the option clearing corporation, they don't handle trades, right? They don't handle the trading. They just look at settled trades, end of day settled trades that the exchanges report. Then they look at the overall exercises or assignments, adjustments for any kind of corporate actions like splits or any other corporate action, spin-offs, anything that's expired. They take that all into consideration using end of day settled trades. So it has to be end of day settled trades. They reconcile all this overnight, and the next day they make available the new open interest. Okay, so that's the start of day open interest. Okay, again, that's coming from another entity. So think of it here. We had two feeds here from the options OPRA, the trade price, the quotes, the stock feed, which is the consolidated stock feed. Then we have the options clearing corporation with the open interest. And that open interest just allows us to see how much interest was there in this open interest in this particular option start of day. If there's zero open interest and all of a sudden we see trades, well, there could be new interest now. Yeah, there's nothing open there, so it could be new interest. If there's a lot of open interest, like over here, then the trades going on here, basically this is displaying that there was already interest in there. There's a big open interest. It could be closed, it could be open, it could be people trading back and forth. But this helps us just determine that piece of information. Here, the exchange, this is the exchange it traded on. So here's Amex, SIBO, Box. And again, that's important when you're analyzing where's the order flow going, which exchanges may have better executions, because now we can see where executions, for example, are happening maybe on the bid, on the offer, in between, where is more liquidity. That becomes important for that analysis. And then we have these trade conditions. So the trade conditions, there are three of them here. One is execute condition here, where it tells us if it's an auto execution, multi-leg. And if you slide down here, so I'm not going to go through all of them because there's a lot of them. You could read about it. Okay, these are how it's reported on tape. So there are different types over here. You have the type of execution. So you have, it could be a price improvement auction like over here. So where it enters into an exchange, and instead of getting executed right away, for example, it will go into its auction mechanism to try to get a price improvement from the specialist or market maker before it either gets executed on a bid and offer, it gets sent away, or it just gets posted. So that's that. And here, if it was a multi-leg option trade, for example, it'll get listed as a multi-leg, which means this was part of a transaction that involved more than one option contract simultaneously. And that also becomes important because now you know, oh, well, this isn't just somebody buying or selling this particular single option. It's tied to another option. So it's some kind of a spread or complex order. You could analyze that from a different angle and different perspective. So I'm going to stop there as we went over all these data elements on the table.
Well, that was an awesome, awesome webinar, D. Great way to start the week. I hope everyone had a great Memorial Day weekend. We will have another webinar tomorrow and the rest of the week. Great job as always, D. Thanks for bringing it to us.
Thanks, Will. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you tomorrow.
All right, great job, D. Everyone have a great day. Trade in peace and enjoy the start of the trading week.